Yes, sir.
Yeah. See, limitations of financial statements and interpretation techniques. So this is the chapter we are doing today. See, of course, some limitations are there in the financial statements even. Financial statements are affected by obvious shortcomings of historical cost information and are also subjected to manipulation. Yes, if you show everything at historical cost, it is not realistic. Why? Because if you are showing things at historical cost, the things right now, suppose if I show a building which I bought for 5 lakh rupees 20 years back, and I'm trying to show that at historical cost, do you think it is justified? No. What is justified? Its value as on
Fair.
today, the market value, correct?
Yes.
That is more
Yes.
realistic. So historical
It's
cost,
a
if
fair
you take
value only, sir.
fair value, yes,
Yes.
the fair value or revalued amount, whatever. Fair value in case when you are speaking about investment property, in case of property, plant and equipment, revalued amount. Okay.
Okay, sir.
So that is one of the biggest shortcomings. So financial statements are intended to give, but financial statements should give the latest and fair presentation of financial performance of an entity over a period and its financial position at the end of that period. Of course, the IASB's conceptual framework and IFRS are there to ensure as far as possible that they do. Yeah, this conceptual framework and IFRS should ensure that the statement, whatever is prepared at the end of the year, definitely should give fair presentation and financial position to the users. However, there are a number of reasons why the information in the financial statement should not just be taken at its face value. Yes, if we take that at face value, it doesn't look realistic. Why? Because in as of now, the things would change in real terms. Correct? Now, there are some problems with the historical cost information. That means if you are showing the assets at historical cost, what problems you may face. Historical cost information is reliable. See, historical, I'm saying some word. Historical cost is reliable. Why? Is reliable. Why? Because
Sir?
historical cost is reliable. That means a value what has got created to the asset that you can see now. You bought that asset at some value. So
Sir?
you are having network issues, I think. Hello.
Sir?
Can you hear me?
Yes, sir.
Yeah. See,
Sir, historical cost is the cost which we purchased the asset only, na, sir?
yeah, we purchased the
Yes.
asset. That is the cost.
Okay.
The cost at which
Yes,
we
sir.
purchased is historical cost. That is
Yes, sir.
reliable. Why it is reliable? Why? Because the value at which you purchased, after all the
Yes, sir.
bargainings and everything. But that is
Yes.
not relevant. But that is not relevant. What is relevant? The current fair value. Current value is relevant. Correct?
Yes, sir.
Why? Because current value is what is the real value of that asset. Now,
Yes, sir.
which can be higher amount or lower amount. So historical cost information is reliable and can be verified. Of course, when you see the books, when you see the bills, when you see the invoice, you can verify, but it is less relevant as the time goes by. The value shown for assets carried in the statement of financial position and historical cost may bear no relation whatever to what their current values and what it may cost to replace them. Of course, whatever you are showing at historical cost, definitely may bear no relation to the current value, and what it may take for you
Sir,
to replace them. Hello,
sir, lot of disturbance.
from my
Now
side,
it's
no
fine.
disturbance.
Now it's fine, sir.
Yeah, the corresponding depreciation charge will also be low. Of course, when you are showing a historical cost, that value was less. So depreciation will also be less. So leading to overstatement of profits in real terms. That is what, if you are showing an asset at 1 lakh, which you bought long time back, today its value is 5 lakh. So your depreciation, what you're showing is less value or more value?
Less.
Less value. So that is nothing but that leads to overstatement of profits. So the financial statements do not show the real cost of using such assets. If you take historical cost, and there is problem with the current value also. Current value can be anything, na. Someone will be ready to pay 5 lakhs for that asset. Someone will be ready to pay 4.8 lakhs for that asset. So see, things every time you may face problems. So we are discussing the issues. Okay. This is particularly misleading when attempting to predict future performance. Of course, if you look at the future, futuristic values is what is relevant, not the past values. So it could be that a major asset will need to be replaced in 2 years of time at vastly more than the original cost of the asset currently shown in the statement of financial position. Of course, when you want good performances in the future, you need to replace the old assets. So old assets, when you replace, suppose after some years, uh, it will be more than the original cost of the asset currently what you are showing in your books, correct? So this will then entail much higher depreciation and interest payments. Yeah, if you will be replacing your old asset and buying a new asset, your new asset value will be high. So depreciation amount will be high. And when you will be buying the new asset at some with some finance, if you finance it by some bank, you need to pay the interest payments also. Now, in addition, overstatement of profit due to low depreciation charge could have led to too much profit having been distributed. Yes. So with less depreciation, high profits, you are distributing more profits to shareholders in form of dividends or like EPS, increasing the likelihood of new asset purchases having to be financed by loans. Of course, what happens if there is a overstatement of profit? You are sharing much profits with the shareholders and you are having less cash with you. So when you have less cash with you, you have to take loans, and then loans, if you take, again you have to pay interest in the future, correct? So the information
Yes,
could
sir.
not have been obtained just from looking at financial statements. These things you should know if you study something properly. Now, in the period of inflation, financial statements based on historical costs are subject to an additional distortion. So inflation is nothing but the times when the values of things are very high. So at that time, if you take historical cost, if the financial statements are still based on historical cost, there's a distortion. Why? Because the realistic values are not seen. Sales revenue will be keeping pace with inflation because you have to sell at a higher price because of inflation, and cost also would be high. Since cost is high, sales would be high, and using FIFO inventory being used to be valued as the earliest purchase. See, you know about the FIFO method now. What is FIFO method? First in, first out. This leads to
Yes, sir.
understatement of cost of sales and overstatement of profit. This is the result of inventory carried at historical cost. So what happens if you use FIFO method during inflationary times? Your cost of sales would be less, correct? Your profit would be high, and that leads to overstatement of profits if you are showing a historical cost. Understood the concept? And with LIFO, what happens? If you value your inventory at LIFO, because of inflation, your cost of sales would be high, your profit would be less, and you pay less taxes. Correct? That is when you
So,
don't use the historical cost. So did you understand the concept? Shall we move forward?
yes, sir.
Can I
Rajeshwari,
explain this last point?
read it once. If you get in doubts, I'll explain. Once again, you read this. I'm
Yes,
saying
that's
FIFO method, if you use, you're selling
yes,
your first in, first out stock
yes,
now, which you bought
yes,
first. So for that, the cost of sales will be less. Why? Because
less.
inflation effect will not be there in that, and your
Okay,
profits will be high.
okay. So this leads to under अच्छा that one.
Understatement of
Okay,
cost
sir.
of sales, overstatement of profits.
Yes, sir. If it is at historical cost.
Yes, in this case, yes, when you're
Yes.
using
Okay. Okay, sir.
chapter is a matter of 10 to 15 minutes more, then I'll move to next chapter immediately. I thought of taking standards, really speaking, but if I take standards now after all these things, I'll tell you what is left over. The only things which is left over is revenue from contract with customers, accounting for income tax, tough chapter, not easy one. That will really test your knowledge. Lease accounting, again a very dry and like headache thing. And financial instruments, very easy chapter, but students tend to take it not immediately. Why? Because new things. All these are four, so I wanted them to be taken at a very good time and properly. Because these four things, if you understand properly, Only 4 chapters are there now left over after finishing these 3. Okay. So provisions and contingencies, that matter will take care of that. I will take care of this 4. So we will take after the afterwards. Now, creative accounting. So you know what is creative accounting? Showing more creativity. Now let's so showing more creativity can happen in 2 ways. Either company wants to show more or higher profits by showing less expenses. That means they want to
By
capitalize.
cutting costs.
Hello.
By cutting costs.
They want to capitalize much of the expenses to the assets. That means they want to add more and more expenses to asset, okay, and capitalize it. So that what happens if they don't expense and capitalize, the profit would be high in the first year. Correct or wrong?
Yes, sir.
Hello. So profit would be high, and they can attract shareholders or investors to invest money in the company.
Can you repeat?
I am saying if company does more of capitalization, or they
Yes.
capitalize more of the costs, that means they add more of the cost to asset value, and they try
Yes,
to
sir.
increase the asset value. The expense is less in the first year, no?
Yes, sir.
Since the expense is less in the first year, your profit should be high. That you are showing purposefully to
Yes.
attract the shareholders. Correct?
Yes.
Because this asset, the expenses, whatever you have added to the asset value, that whatever you have capitalized will expensed in the future by way of depreciation. So in future your profits will be less, but this year your profits are high, no? First year,
Yes, sir.
because of capitalizing. So this kind of creativity they do, and if they expense, they would try to show less profits to pay less taxes. So this kind of creativity the accountants would do. Okay. So I'm reading out the points. If anything is there, you can trace it out. Listed companies produce, you know what is listed companies, produce their financial statements with one eye on the stock market. So as I said, they try to do all these things, manipulations. Where possible, they like to produce financial statement which shows analysts what they are expecting to see. Analysts always want good profits from the company, good results from the company, so that they can suggest people to buy company shares.
So voice is breaking, so
So these people change those financial statements and
Not change, they do creative accounting, as I said you right now.
manipulate.
repeat once again. Voice was breaking.
See, you are having network issues.
No, sir, no network issues, sir, today.
See, Meghna is clearly understanding Rajeshwari. Meghna, you got my voice,
I
na?
don't have any network issues,
This
sir,
is not
today.
your fault, not my fault. It is network fault,
Can you
Rajeshwari.
explain once again, sir, this point?
See, if I go on explaining like this, repetitions, then
Hello?
okay. Yeah, I'm explaining. Okay.
Hello?
Hello.
Yes, sir.
Listed companies produce their financial statements with one eye on stock market, and where possible, they like to produce financial statements which show analysts what they're expecting to see. So, listed companies, they make financial statements in such a way that it would be appealing to the potential investors who wants to invest in the stock market. Why? Because they want to show more profits. As I gave an example here, with more by showing a higher profit or more profit, what they are planning to do, they are planning to pull investors to invest in their company. Correct? Now, for instance, a steady rise in profits with no peaks or troughs is reassuring to potential investors. See, peaks and troughs is ups and downs. See, a company which is having ups and downs is kind of more risky. But a company is having very good trend, only increasing trend. Do you think investors have problem with such company? No. So companies try to show these things to the investors. Okay. So this
So it
has
means
been,
if
sorry.
they show it as the investors will to see the company as rising, no, sir?
The investors always want to see company as a profit making machine. Not they won't even tolerate ups and downs. See, if there are ups and downs in things in life, do you think it is happy, or always if it goes up it is good?
Always goes up. It is
We always want to be happy. Now we don't want to be sad. But sad, these two things go hand in hand. Okay, in company's case, you always want a good performance. You cannot compromise with bad performance in which you are investing, correct?
Yes, sir.
That is what I'm saying. So people would always go for companies with steady profits, higher profits. They don't want any peaks or troughs, any ups and downs. Sometimes high profit, sometimes low profit. No. Companies could sometimes achieve this by using provisions to smooth out peaks and troughs. So what they would do, they would make some provisions, like we can have a loss in the future, or we can have some expenses in the future. For that, they make some provisions beforehand, so that whenever there is a problem or issue or one time expenditure, if they are incurring, these provisions they can use, so that things would be smooth in the company, correct? There will be less peaks and troughs because company is having all the arrangements done now. This
The difference between provisions and reserve, sir.
you should say. I already repeated this point. Provisions are made for specific purpose to meet some obligations. Reserves are nothing but you are accumulating company you are accumulating money for future investment. Okay.
Okay.
There is a purpose for reserve. Now reserves are there to accumulate profits, but provisions are made for specific to meet some obligations, like provision for tax, provision for doubtful debts. Those are expenses, correct?
Okay, sir.
So this has been largely outlawed in IAS 37, like the provisions. We will be studying about this when we'll be starting the chapter. But companies can still achieve similar effects by delaying or advancing invoicing or manipulating cutoffs or accruals. What company can do? They can still achieve good effects. How they can achieve good? That means they can try to achieve benefits. They can try to show their company as a profitable one always without peaks and troughs. How? They can delay payments to suppliers, so that the cash reserves would be shown high. They can pay something in advance itself, so that they can get very good discounts that would increase profit. Got my point? Or they can manipulate cutoffs or accruals, like something which is outstanding. They can manipulate those things. Okay. Are you following, please?
Yes, sir.
Yes, Rajeshwari. Hey,
Sir, I
Rajesh.
got disconnected, sir. Just now I joined.
Now, Rajeshwari, again you will tell to repeat. So better you can watch the
No,
video.
sir.
That
No, sir. I will see the video, sir.
see, I am not frustrated with that. Network issues will be there. But
Yes,
again, if
yes,
I
sir.
go back now, my flow I will lose my
Yes,
flow.
yes.
Okay.
Yes, sir. That's fine.
Please understand me. I am never ever frustrated with you children. Correct?
Sure, sir.
Yeah. Directors who are paid performance bonuses, like directors would be paid for their good performance. So, the directors that will make them to show a good thing always on the statements on the paper. They cannot compromise with less profits. That means if they show high profits, that means they capitalize more and more expenses. They expense less, they capitalize more. That would increase the profits, na, and they would get higher bonuses for good performances, correct? Because everything is there in their hands. They always want to show spectacular results. An important aspect of improving the appearance of the statement of financial position is keeping gearing as low as possible. Yes, if they show the loans and the debt finance as low as possible, that is what would attract the investors to invest in the company. Why that would attract the investors to invest in the company? Because it is a less risky company, more solvent company. We learned in the ratio analysis, correct? Investors know that interest payments reduce the amount available for distribution, and potential lenders will be less willing to lend to a company which is already highly geared. So the company's directors always want to show less gearing. They always want to arrange more funds through equity. Why? Because high debts would make the company to pay more interest payments, which would reduce the profits. And point number two is, no one would like to invest in highly geared companies. It's very risky.
Yes, sir.
A number. So what they can do, what kind of creative accounting measures they can take. Now this is only the last paragraph of this topic and most important paragraph whereby you can learn about creative accounting. Correct? When you become accountants in any company, you'll understand how the creativity, what kind of creative accounting goes on, what accountants do. So a number of creative accounting measures are aimed at reducing gearing. See, there are a lot of options now. You can take a property on lease instead of buying it. When you buy a property, you have to take a big amount of loan, correct? So that increases your gearing and you have to pay more interest. But in case of leasing, you need not pay, you don't take loans. Instead, you just agree to make some periodic payments every month, correct? Hello? Are you following?
Yes, sir.
So
Yes, sir.
periodic payment.
Yeah, so suppose 6 lakh is the lease liability for me for 10 years. Divide the 6 lakhs in 10 years and divide 6 lakh in 10 years. How much? Tell me. So some points about leasing also we'll discuss. 60,000 per year. Divide by 12 per month 5,000. You are paying us lease payment. And here, are you doing any down payment or are you taking any loan? No. This is just a future obligation. As per the contract, you need to pay. Got my point?
Yes, yes, sir.
So that would save a lot of money of yours and even the risk also gets reduced. But here you cannot, here in finance lease, even though you have profits or losses, it doesn't matter. You have to pay that fixed amount. That because it's a binding agreement. Now. So everything has its pros and cons, correct? But regulation is increasingly catching up with these measures. So what company does, to reduce the gearing, they can lease the property. They can take a property on lease so that they did not take loan and pay high interest amounts. So in past, parent companies could find reasons to exclude highly geared subsidiaries from the consolidation and could obtain loans in the first place via such quasi subsidiaries. So what companies used to do in the past, parent companies could find reasons to exclude. They excluded highly geared subsidiaries. That means the subsidiaries which were lot of debt ridden, lot of loans those subsidiaries have taken. They used to exclude them from consolidation and could obtain loans in first place via such quasi subsidiaries. That means they could show by taking that subsidiary into consideration, they could take big loans and exclude subsidiaries from consolidation. With that, no debt they are showing, correct? So that loan never appeared in the consolidated statement of financial position. See, this parent company wanted to take a big loan. So this parent company should approach the bank, na? Please tell me yes or no.
Yes, sir.
Now what these guys are
Yes,
doing, they formed a subsidiary company and that subsidiary company is taking a loan. Okay, so the loans are shown in this subsidiaries books. Not and this parent doesn't want to consolidate this subsidiary with them. So now parent is saved now. They're not showing big loans now.
yes, sir.
So what happened is this was a loophole.
So
And
parent
again,
is saved.
yeah, they are not consolidating with the subsidiary. So loans are all shown in the books of subsidiary, na?
Okay.
It used to happen in the previous past. Now this cannot happen. Now you cannot exclude those subsidiaries also. You need to disclose many things. Why are you not including that subsidiary? Why are you not consolidating with them? Now it cannot happen. Now, however, you need to consolidate, whether it's a debt-ridden subsidiary or taking loans on the name of subsidiary company, it doesn't matter. Okay, because things have been rectified in IAS 27. Shall we go forward?
Yes, sir.
Assets could be sold under sale and
Yes,
leaseback
sir.
agreement. I already explained you leasing and all, and this point I clearly told you. Okay. Now intra-group transactions. So what is this intra-group transaction? I think you already know this intra-group transaction very well. But see what companies
sir.
are doing, how companies are taking advantage of this. See, understand. There's a concept called transfer pricing. I will tell you what they do. It is common for entities to carry on activities with or through subsidiaries and associates. Yes, they do transactions among themselves also. Why they do? There is a reason behind that. or occasionally to engage in transactions with directors or their families. That is related party transactions. What is that? What is this related party transaction?
Related party transaction.
When
Means that
transactions
you're
happen with a known
It's
person.
between
with the
directors
people
and
whom you know.
families.
Yeah, yes. Because you're going to learn this afterwards in the corporate reporting subject.
Okay, sir.
Finishing this chapter, but you know every chapter has its own explanation.
Yes.
What to do? See, if I leave points and go like that, again you'll be having a number of doubts. Okay. Now, yeah. So the point is that such transactions cannot be assumed to have been engaged in at arm's length or in the best interest of entity itself. Arm's length is as if you are selling to outsiders. Correct? See, arm's length is what you sell to outsiders. You cannot sell that. If I am selling to some customer, I'll sell at a higher price. The same product I cannot sell to my subsidiary at higher price. No, I cannot do that. So actually, if I sell my subsidiary also at the same price, that is good for my company. But the point is that such transactions cannot be assumed to have been engaged in an arm's length transaction or in the best interest of entity itself, which is why investors and potential investors need to be made aware of them. So what happens here? Transfer pricing can be used to transfer profit from one company to another, and intercompany loans and transfers of non-current assets can also be used in same way. So what happens? I'll tell you. Transfer pricing. Suppose a company is in United States, this they do. Suppose a company is there in Oklahoma, and there is a state called Nevada. You know about the famous cities Las Vegas and all. It is there in Nevada. So Oklahoma, you have a state. Here the taxes are 40%, for example. Just a second. Yeah. So what companies can do is, the tax rate is, yeah. Here the taxes are 30%. Here the taxes are kind of, let's say, 20%. So what this parent would do is, they will not sell the goods here. Instead, what they will do is, acha, okay. I will tell you, just a second. I will sell at lesser price, which will increase more profits and pay less. Yeah. So what happens? The parent would sell the goods to subsidiary. Whom they will sell? Hello? The parent would sell the goods to whom? Subsidiary, correct?
Okay.
So they can do the sales in this part also, in Oklahoma. But here the taxes are very high. They need to pay more taxes. So they will sell the goods
Yes.
to this Nevada subsidiary at lower prices. And here whatever the profits are generated are higher profits. And those profits they pay less taxes. So they try to save taxes because of this transfer pricing arrangements. Okay. Now, seasonal trading. So this is another issue that can distort reported results. Many companies whose trade is seasonal position this year end after their busy period to minimize time spent on inventory count. At this point in time, the statement of financial position will show a healthy level of cash and receivables and a low level of trade payables, assuming most of them have been paid in one season. See, seasonal business is nothing but in season they will be doing very well. In off season they will not be doing well, correct? So many companies whose trade is seasonal, their trade is seasonal, it seems. In festive season, they will be earning lot of money. Position their year end after their busy period. That means their year end they will be showing after the busy period only. Why? To minimize time spent on the inventory count. At this point in time, the statement of financial position will show a healthy level of, because in the season they will be earning good amount. So statement of financial position will be very good that time. Thus, the position is reported at the moment when the company is at its most solvent. That means when they are getting lot of revenues, very high revenues, and have very less loans to pay, that time they want to report their results. The companies which are involved in seasonal trading business. So a statement of financial position drawn up a few months earlier or even perhaps a few months later when trade is still slack but fixed costs still have to be paid may give a very different picture. Yes, that means during the season if they are showing everything looks good, but if when off season comes they will be having higher fixed cost. That time they'll be having less sales or less revenue they'll be generating. That time the picture would be different than the time when their sales were very high. Okay. Asset acquisitions. The major asset acquisitions just before the end of an accounting period can also distort results. So we already learned now, whenever company want to sell some asset, okay, that is they have to show it in the held for sale category. But what happens is companies, what they are doing, they are purchasing the assets just before the end of the
End
accounting
of an
period.
accounting period.
So why the statement of financial position will show an increased level of assets and corresponding liabilities. That means if they have taken the assets on loan or they have taken the assets on lease liability. But the income which will be earned from utilization of the asset will not yet have materialized. This will adversely affect company's return on capital employed. You know, like when they purchase the assets in this way, they would not get good benefits from the assets now immediately. So then what will happen? Your ROC will be impacted. How? This they will try to, what they will do, suppose my company's assets were 10 lakhs and my company's earnings were 1 lakh. So on $1, I was earning 10 cents. Now what happened? At most sudden my company has purchased one asset at the end of the year. Now my asset value has gone to 20 lakhs and my earning is still 1 lakh because immediately I cannot use the asset and generate revenues. So now on $2, I'm earning how much? So is it this is good or this is good? Please tell me.
First one, sir.
Yeah. So here I'm putting more money to earn this the same profit. So my ROC has got impacted. Now companies will do this purposefully to show losses, to hide their scam or something at times. They'll be doing scams now. Or else one more reason can
Yes,
be
sir.
less profits so that less taxes. That also they want to do. Acquisitions and disposals. A company may have acquired or disposed of a subsidiary or a division during the year, and the effect of this will need to be isolated in order to assess the underlying performance. So see what happens, companies sometimes they buy or they sell their own subsidiary or division during the year, and the effect of this will need to be, they don't show that effect. They don't show that sale effect or purchase effect. That we will be dealing in chapter 19 in more details. Why they do that? See, what are the accounting policies and the limitations of ratio analysis? See, I have already explained you about accounting policies now. If you change accounting policies, then what you have to do? You have to give retrospective effect, correct?
Yes, sir.
Yeah. But why? See, at time it is, see, first of all, there is a point called consistency. The companies should always use whatever the methods they are using consistently. They should not change it. When they change it, they should disclose it. That means that should be in the best interest of the company. But at times what they try to manipulate the results. For example, straight line method, diminishing balance method. Here, when they were using diminishing balance, their profits were high or less.
Yes, sir. In diminishing balance,
Yeah, with the passage
the
of time,
profits will be less.
with the passage of time, diminishing balance method will show less depreciation, na? So profit would be
Yes,
high.
sir. Yes, yes,
That
yes.
time,
Yes, sir.
so they want to change now to straight line to lower the profits. and pay less taxes. Is it a manipulation? Yes, they do it purposefully. They do it. They want to change
Yes.
from LIFO to FIFO. There may be some motive to do that. Correct. So they want to show less profits. They want to give less dividends. They want to pay less taxes. All these things they do.
Yes, sir.
These are all manipulations. And see, ratio analysis, I have already explained you all the advantages and disadvantages. We'll just go for give a reading to this. Okay. See, the consideration of how accounting policies may be used to manipulate company results leads to some of the other limitations of ratio analysis. In a company's first year of trading, there will be no comparative figures, of course. So there will be no indication of whether or not a ratio is improving, because some ratios are relative measures like gross profit. Gross profit is not an absolute measure; it's a purely relative measure. Why? Because to know whether this year is good, you should know previous year gross profit. Until and unless you know previous year gross profits, you cannot decide whether this year was a good year or not. Comparison against industry averages may not be that revealing. A business may be subject to factors which are not common in the industry. Of course. See, if you want to compare your results with the industry average, therefore, suppose I speak about an industry. I am speaking about car manufacturing. There are many players or companies in this, like Maruti Suzuki, like Hyundai. So these guys are car manufacturers. They are companies in this particular industry, correct? So comparison against industry averages. So this particular industry of that's car manufacturing industry, there are 10 firms. There will be average performance of this industry. So comparison between industry averages may not be that revealing. They don't reveal, it seems. A business may be subject to factors which are not common in the industry. Yes, sometimes there may be some factors which you may face individually, but that is not the case with all the firms and the entire industry, correct? For example, a fraud happens in Hyundai. Do you think the fraud happens in entire industry? Please tell me. Hello. I'm asking, a fraud can happen in Hyundai. Do you think the fraud can happen in entire car manufacturing industry, or
Yes,
the
Madam.
No, sir.
yeah, the
No,
strategies
sir.
the strategies of Hyundai company is not going well in their favor. Do you think that is going to impact the entire industry? No. Ratios based on historical cost accounts are subject to distortions. I already explained you about that thing. Okay. Why? Because your undervalued assets will distort ROC, na? Because your assets value will be less. So your denominator will be less, your numerator will be high, and you will be kind of showing higher EPS, that higher ROC. Why? Suppose the asset value should be 10 lakhs, but because of historical cost it is 5 lakhs, and my revenue is 1 lakh. 1 lakh. So here on $1 I am getting 10 cents. Here on $1 I am getting 20 cents if I convert like that. Double, na? Here I am spending 50 cents
Yes,
and
sir.
getting $1. Like that I'm getting 10 cents. That is great, na? Yes. Ratios are influenced, yeah, because whatever
Yes.
the accounting policy company chooses, based upon that, the ratios can differ. For example, a company wants to show the assets at revalued value, so ROC may be high. The financial statements are subject to manipulation, and ratios can also will give you distorted or like wrong information about company. And like inflation, that time they will be using LIFO instead of FIFO to manipulate, or FIFO if they use overstatement of profit, higher lesser COGS, so overstatement of profits. And no two companies even operating in the same industry will have same financial and business risk profile. Of course, that will differ. So comparison of two companies based upon ratios is also sometimes not good. Why? Because level of gearing may differ in different companies. Why? Because Honda can raise money with lot of share capital. Do you think a new company which is entering like Mahindra and Mahindra, suppose it's a very new firm, it may not get money in form of share capital, it has to take loan, and its gearing level will be high. Last and final point of the chapter, other issues. Are there other issues which should be looked at when assessing an entity's performance? Factors to consider. How technologically advanced it is. If it is not using the latest equipment and processes, it risks being pushed out of the market at some point or having to undertake a high level of capital expenditure. Of course, see, today's scenario, the world is very technologically advanced. If you use the same old things and same old techniques, you will be out of the market, correct? So if you use old things, your performance would not be good. If you go for new things, you have to buy latest equipment. Your cost will be high, but that would improve your profits in the coming time. Okay. Now, what are its environmental policies? See, if a company is a big polluter, lot of penalties on it, and many people don't want to invest in a company which is not considering NSG regulations properly. That is like ESG, that is environmental, social, and compliances, if they are not following all the rules and regulations. So people don't want to invest in such companies which are poor at these three things. What is the reputation of its management? So you need to give these things actually. And if it has attracted people and kept them, that is a positive indicator. Its mission statement, why it is existing, for what is its mission to achieve, and whether they are fulfilling or not. Reputation as an employer, how
So
they
can
are
you repeat
are
one
they
second?
treating. Sorry. Yes.
So can you this point, so
Sorry.
so can you repeat once again? Your voice was breaking.
Yeah. What is the mission? What is its mission statement? See, for what the company is existing and why it came into existence, what it wants to achieve. What is its reputation as employer? Like, are they giving proper salaries or remuneration to their laborers or employees? What is the market size of the company? And how strong is its competition? Is it in danger or of takeover? All these things should be considered. Done with this chapter.
Sir, it's theoretical only, no problems.
Theoretical only 3 chapters. But we need to sometimes discuss now. I don't discuss then. What do you say? Do you want one more chapter or tomorrow I shall take? Tomorrow, sorry, I will not be available. Day after tomorrow.
So now what you take, sir?
Sorry?
Now what you take, sir? Another chapter.
Okay.
Sir, how much time will it take, sir?
Now you are asking a question. It may take 1 more hour, I think.
Okay.
It will take surely then. How? I see. I cannot polish
Yes.
and move away, na? I cannot polish the things
Which
like
one
that.
will you teach?
I want to justify things. Our status, first let us check. Only 3 pages in this. I did not forget.
Yes.
I will cover surely. In this, agriculture is there.
Reporting finance.
Yes, I know. 1, 2, 3. See, these are simple ones, no problem. That I will be taking 2 sessions from Tuesday onwards. 8:30 to 10:30, and madam will be taking one 6:30, something like that. So we will be taking two sessions. I already discussed with madam. 1, 2, 3, 4 crucial chapters. Others are normal ones, can easily be dealt with. Okay.
Okay.
Only 4 crucial chapters are there. Rest of the things are done. My worry is you people should become good in all those chapters first of all. So accounting for inflation shall we do?
Okay, sir.
I will see how much time it will take because I even did not have my dinner. No one is there to cook. I had just one vada pav in this full day today. Only one vada pav and one this what we say? One pineapple juice from morning till now. What to do working full day? No time. We will see how many pages both the chapters are having. This is page 1, 2, 3, 4, 5. It's a big one only. We will take that non-profit. That will be better. Okay, let's start. It's a small one. Let us find out what is there in this. See, we are dealing with specialized non-for-profit and public sector entities. So, specialized is for special purpose. The entity has been created. Non-for-profit is they are not working with profit motive. And the public sector entities, of course, they also don't work for profit motive. They want to work. They work for service motive. Okay, they work with service motive to give good service to the. For example, if I take about Indian Railways, don't expect they are earning. They are existing for profits, because if you take private what we say service to go from here to Delhi, your ticket should be very high. But if you see the fares in Indian Railways, it is fairly less. Okay. So the primary aims, the accounting requirements for non-for-profit and public sector entities are moving closer to those required for profit-making entities. Yes. However, they have different goals and purposes. See, profit making or non-profit making, these are the two entities which exist. This is solely for profit, this is not for profit. But these are also kind of moving towards this now. Why? Because even though they are for not profit, but they definitely have to prepare the books of accounts, and they have to see whether, because many people donate their money for these entities, correct? Donations, they get money in form of donations, so they have to account it. That means where each and every penny is spent. So they, whatever the surplus they make out of it, they don't share it with the donators, the people who have done the donations, but they use it for creating more services and expanding them to more people. Okay, to cater needs to more people. That's what. So what organizations do we have in mind when we refer to NPO? Central government departments and agencies, local and federal government departments, publicly funded bodies providing healthcare, further and higher education institutions, charitable bodies. The first four are public sector entities, and the charitable are private, not for profit entities. But they are non-for-profit. They are private but non-for-profit. Non-for-profit entities have different goals and purposes to profit-making entities and responsible to different stakeholders, of course. However, they are dealing in very large sums of money, and it is important that they are properly managed and that their accounts should accounts present fairly the results of their operations. Of course, see, in companies, shareholders invest their money, but in these companies, donations, they get donations. So they should account everything, and because since lot of money is involved in these companies, people should not take advantage of this charitable trust, because many of the profits what these guys earn are exempted from tax. Government won't collect taxes, it seems, from them. So people should not take advantage of that, and the people who are managing these NPOs should also not take advantage of people's donations. they should use it honestly. Until recently, public sector accounts were prepared on cash basis, that is receipts and payment basis. I think you have done your non-trading concern chapter in your intermediate, so you know that. Hopefully, if you were a good student in your intermediate. A transition is still in progress, which will get them operating on accrual basis. So transition is going on, no update till now, in line with normal practice in the private sector. So there is also a conceptual framework, that means the framework of concepts for these non-for-profit entities. Okay, give me a second, I'll just drink some water and come.
Hello. Hello.
Yeah, I said I'm going to drink water.
Okay, sir.
Yeah, I'm back. So conceptual framework for non-for-profit entities, the International Federation of Accountants published phase 1 of a public sector conceptual framework in 2013. So who has prepared this? IFAC. Who prepares the conceptual framework for, we have a conceptual framework now, so IASB also has conceptual framework, which we have studied in the first chapter. So they prepared, they published only the phase 1 of a public sector conceptual framework in 2013, long time back. It has some 4 chapters, it seems. Role and authority of conceptual framework, like what is the, why they have prepared this and what is the role of this and how, what kind of authority it has. Objectives and users of general purpose financial reporting. So these companies also have users, it seems. What are the qualitative characteristics? That means whatever the statement they prepare, what is the qualitative characteristics of that, and what is a reporting entity based upon the conceptual framework. Okay, how they derive this as a reporting entity. So definitely, you know, whichever prepares the financial reports at the end of the year is a reporting entity. What kind of characteristics they should have? The information should be relevant, reliable. Already we studied in the first chapter. Objectives and users, definitely the people who donate money, okay, government, etc., who wants to keep an eye on these kind of organizations, so that people should not misuse these organizations for their own different motives. So in preparing the conceptual framework, IFAC had to bear in mind that non-for-profit entities have different objectives, different operating environments, and other different characteristics to private sector business. Some of the issues that arise in considering financial reporting by non-for-profit entities are insufficient emphasis on accountability or stewardship. So what are the issues that arise in considering financial reporting by this? Because there is less emphasis, less importance on accountability and stewardship. They are less accountable, it seems. So a need to broaden the definition of users and user groups. So who are the users? They should not say only donate, the people who are donating are users. Who is a user of your service? The emphasis on future cash flows is inappropriate. See, they should not strive and should not always die for cash. They are existing for non-profit reasons now. So even though they get cash or not, no problem, because donations they will get. Insufficient emphasis on budgeting. So budgeting, they should also budget. They should not use things which are costly and which are out of the box. They should try to restrict their expenses. Accountability and stewardship. Non-for-profit entities are not reporting to shareholders. Definitely. See, companies are accountable to the shareholders, na, and directors are like stewards to the shareholders. Because they work like agents to the shareholders. They are because they are working on behalf of the shareholders. But it is very important that they can account for funds received and show how they have been spent. Of course, accountability should be there. We know that they are not someone to answer shareholders, but they should also show like how they are spending money. In some cases, resources may be contributed for specific purposes and management is required to show that they have been utilized for that purpose. That means the money has been spent for something, for opening a hospital unit or something. So that money really has been spent for that only or not should be shown. Perhaps most importantly, taxpayers are entitled to see how government is spending their money, because government is a non-for-profit organization, it seems. Many of the companies which are government companies are public companies, non-for-profit, and they solely work for betterment of the society. But we are very much concerned what taxes we are paying to them is really being used for our development, or they are doing some corruption or eating away that money. Now,
Yes, sir.
users and user groups. The primary user group for NPO is providers of funds, the donation, the people who give donation. So they definitely want to know about about what their money has been used for. Cash flow focus. Of course, these are non-for-profit organizations. They should not be looking for businesses and all. Whenever they don't have money, donations they can get, and they should be doing work in a cost-effective way so that they can save money. And they should budget also. Budget is nothing but financial planning, so that they could save more and use that saving for more and more inclusion of more services and for betterment of the society. See, conceptual framework itself is not the only solution, na? The concept, preparation of concept is not the only thing, but following that is also important thing. So regulatory framework has been made so that everyone should follow the concepts rigorously. So there is a general move to get public bodies reporting under accrual system. Many private non-for-profit organizations still use cash accounting. So what is happening is, a need has been created that government should use accrual system now, being a non-profit organization, even government entities or government companies. Private companies still go with cash accounting. That means private charitable trusts. Regulation of NPO is important now, principally because many scams have happened, it seems, in the previous past, principally local and national governments. And government doing scams is also a biggest question mark, because they are not for profit. Now they are not for profit entities, but they are doing scams. They are not. See, when we see our roads, do you think our roads are up to the mark? We have all the pothole roads. I know
Yes,
India is a
sir.
country of 135 crore people, and only 6 to 8 crore or 10 crore people pay taxes. The government can also say we are
Yes,
getting very less taxes. We can't make a good quality road.
yes,
But in UK and US, they cannot do that because people are paying the
yes, sir.
taxes very genuinely and honestly.
Systematic.
Yeah, so regulation of non-for-profit entities, principally local and national governments and governmental agencies, is by international public sector accounting standards, which come under IAFC. So what are these international public sector accounting standards? All the international, since we are studying about the international financial reporting standards, so international public sector accounting standards are public sector, whatever they are in UK, should follow international standards, it seems. So, which are specifically for these entities. So the IPSAB is developing a set of standards based on IFRS. So to date, following IPSAS have been issued. So presentation of financial statements of public sector entities, cash flow statements by these entities, net surplus or deficit for the period, how much they have made, any errors or changes in accounting policies, effect of changes in foreign exchange rates. If they are supranational, like World Bank and all, they will be giving funding to other countries, and non-for-profit, World Health Organization, supranational organization. So foreign exchange changes, borrowing cost, and consolidated statement of financial statements and accounting for controlled entities. So these standards actually you need not study, not there in your syllabus also, and need not go for it even, but should remember this, because this chapter is not completely given to you. Just theory they have introduced. Do you have this in Kaplan?
Need to
Rajesh?
see, sir.
Yeah. So accounting for investments in associates, if they have the financial reporting of interest in joint, they make joint ventures, revenue from exchange transactions, reporting in hyperinflationary economies, construction contracts, inventory, leases, all the standards who has made for non-for-profit organization. See, government companies will be there now. Government companies will be constructing roads and buildings. So construction contracts they'll be giving, and they'll be taking even. And they'll be using they'll be see all these big companies, boss. ONGC, NTPC, big government companies. They'll be coming across all these things. They'll be having PP. They'll be also having investment property. They'll be also raising funds in the form of equity, leases. They lease properties also. Like many of the government banks, they take properties on lease and they operate. You may be knowing Rajeshwari, like madam is a bank employee, so you may be knowing banking transactions, how they go. I hope you may
Yes,
be knowing.
yes, sir.
I hope you may be knowing,
Yes, sir. Yes, sir.
because
Yes,
madam would
sir.
definitely discuss, not at times.
No, sir.
No,
Not
maybe
much.
sometimes she would have discussed casually. You did not take it seriously, maybe.
Very,
Just
yes, sir. Very
casually.
less, sir. But I'm interested in that subject.
No problem, just take it easy. Impairment
Yes,
of
sir.
CGUs and non-cash generating assets and related party disclosures. If at all government companies are headed by some officials and they give contracts to their own known people, politicians they do now. They'll be giving contracts to their known
Yes, sir.
companies and doing scams and all. So all these things are there. And these guys are already stressing for accrual accounting now for public entities. So you know now what are the characteristics of non-for-profit entities in private sector. See, I won't explain all this. You already know. They are only for profit motive. Even though in private sector, even though they are only for non-profit motive, even though in private sector or public sector. Public is government companies, private is normal charitable trust. Okay. So their objective is to provide goods and services to various recipients and not to make profit. Their recipients can be any general public. See, I have a hospital nearby my office, CC Sharoff. It's a non-for-profit organization, charitable trust hospital, whereby doctors only charge 100 rupees for a patient. When you go to private, they charge 500 rupees in Apollo and all. They are generally characterized by the absence of defined ownership because there are no shareholders now. So, like there's no pressure also in them, and they need not transfer or anything. They need to give, and they may have a wide group of stakeholders to consider, like public. For example, public is the biggest stakeholder for non-profit organization. The revenue generally arises from contributions, donations, membership fees, etc. There's a club. Many people take membership fees in clubs, now. They pay membership fees. Library, they pay membership fees. They don't earn from sales in general. Subscription fees. Their capital assets are typically acquired and held to deliver services without intention of earning a return on them. So they don't see all this return they should get from the assets and all. They only kind of see that this asset should be used for the betterment of public. Here also things are same, but only here government comes into picture. Generally they are dependent. What is the source of revenue for government? The main source, correct? Hello.
Taxes.
Taxes and fines, penalties, all these are also revenue.
Yes, sir.
That's what- yeah.
Yes, sir. CGST and SGST.
Yeah, taxes. Non-for entities specific issues, while general trend is to get non-for-profit entities producing accounts which are based as far as possible on the provisions of IFRS and which are generally comparable to those produced for profit and making entities, there are two issues which have been to be resolved. See, they have to make as per IFRS kind of anything, but there are two things. Actually, they are not using accrual accounting, and they are using cash. They are doing on cash basis, correct? So while there has been a general assumption that for a public sector entities, most move to the accrual basis will result in more relevant and better quality reporting. No actual cost benefit analysis has been undertaken on this. Actually, till now, they have not adopted this accrual basis. One of the arguments in favor of adoption of accrual basis is that it will be possible to compare the cost of providing a service against the same cost in private sector. That means, see, here they are using cash basis. Private sector is using accrual basis. Comparison between this and this is not possible. But if you change this into accrual basis, what we can do is, we can really understand what, suppose railways, Indian railways you have. Now suppose government is giving chance to private parties to run their own trains. So here the private trains will be run by the people and they'll be using accrual accounting for that. Here these guys will be using cash basis. So do you think Indian Railways performance can be compared with the private railway performance? No. But both use accrual, it becomes easy. So better thing, we can betterly understand, in better way we can understand who is more cost effective and who is more cheap, giving services at less rate, less price. Are you following? Hello.
Yes, sir.
Okay. Almost all. We are coming to the end of the chapter now. Definition of a liability. See, conceptual framework defines liability as a present obligation of entity arising from past events. The settlement of which is expected to, okay, we know the definition of liability. A liability is recognized when the amount of outflow can be reliably measured, okay. Public benefit entities are subject to a commitment to provide public benefits. They are liable to do that. But there is an issue to be resolved over whether this commitment meets the definition of liability. Yes. So on orally they say this is my liability, this is my liability, but on books they don't do that. So that is the reason why we are not able to question them. So in this situation there has been no exchange. Entity has not received any goods or services for which it is required to make settlement. See what happens when we pay money to some shopkeeper, he has to deliver, he is liable. But when you pay taxes to government is giving you the assurances, but do you think that it is the government's, okay, on papers everything is a responsibility, but are you paying money directly to the government for some service?
No, sir.
No.
If you pay directly, then there is a commitment. If you take a railway ticket, then there is a commitment from Indian Railways. But what the taxes we pay definitely is in form of, it's indirect money paid to them, no? So there is a issue of settlement. So a distinction can be drawn between general commitments to provide public benefits and specific commitments to provide public benefits. Specific commitment can be regarded as present obligation. If there is a specific commitment from government that they have promised to do, then that is okay. But it can be argued that the obligation only arises when the entity formally undertakes to provide something such as non-performance related grant. If the grant were performance related, the entity would be able to withdraw from agreement if the performance targets are not reached. So specific commitment is government has given you a commitment that if you perform well, we will be giving you a grant. But if you don't perform, then so specific cases it's all right, correct? If you don't perform, then that agreement won't be there, no? Government won't give you a grant, correct or wrong? Please tell me.
Yes, sir.
Yes, sir.
There is also an issue of reliable measurement. Governments in particular often find themselves funding projects which go a long way over budget, suggesting that reliable measurement was not obtained at the outset. So this issue is still being debated by this body. It is of major importance in financial reporting of social policies of government. Performance measurement is definitely whether they are able to perform well depends upon how effectively they are giving you services at less cost. Definitely the profit is not the performance measurement for them, but their services, how good they are and effective and economical, and how people are satisfied with them, and how they are trying to reduce their cost. So all these things should be measured, but cannot be measured on par with the profit making organizations, okay, because they don't have that pressure to remain solvent, insolvent, nothing like that. No one is claiming. Done with this chapter almost all, and there are some public sector entities here. These will have performance measure laid down by the government. Government will tell you now about the performance measures. Like how will you check the government's performance measurement? Government is giving houses to the homeless people. They are doing some percentage of rubbish collections. and making the area clean, number of children in care adopted, education to the children below 14 years age in India. All these things are there. Best value is based on principle of 4 C's. So best value is nothing but value for money they should give us. Who? The government. Value for money, in the case, in UK they do, we expect also from the government, but in UK they do, here we don't. We expect, but the governments don't do. So best value is based on the principle of 4 C's. Challenging, why? How and by whom a service is provided. Comparing performance against other local authorities. Yes, you can compare and see whether who is doing well. You see, Mysore city, many times they take name of Mysore city and Indore city, the most cleanest city in India. So we compare Hyderabad with them, correct? Consulting
Yes, sir.
service users and local community, and using fair competition to secure efficient and effective services. Most can. Done with this chapter. Now, do you want one more chapter or enough?
Enough, sir.
So from tomorrow you won't be taking, no?
Only morning. Evening I am not available.
Okay, sir.
And this is done.
From morning, sir.
For morning? No. Online I cannot take because I need to sleep. I need to pack my bag. Everything is there.
So no classes, sir, tomorrow?
No class. I am traveling, I said, no?
Yes, sir. Okay, sir.
Evening times are not suitable for me. And in fact, morning times are not suitable for you. You already said.
Yes.
And in fact, I may be also having lot of work, packing and all. So I need to rush to airport by 12:30 tomorrow. Okay.
Okay,
So,
sir.
don't worry. After coming, I'll be taking 2 sessions, and there also I'm seeing for some arrangement what I can do and what I can do best for you people. I'm seeing, but I
Okay.
cannot guarantee it's a marriage house. So getting
Yes, sir. Yes.
I'm stuck.
Hello.
This is a six months back book tickets. Okay, fine. This
Okay.
is done now. So
Yes, sir.
I really say, hopefully, I'm trusting you people to go through all the topics properly and prepare till now whatever we have done. After coming, I'll rush like anything with perfection and we'll finish and start everything.
Okay.
Thank you.
Okay.
Thank you.
Thank you, sir.